Hello students, good afternoon. How are you all? So today we are going to start with chapter number 2 of our triple A syllabus. Okay, so let me quickly present my screen. That's amazing. That's amazing. Okay, so now what we are going to do is we are going to use the VGLD book that is available to all of us. Okay, please understand that this is the only book that we are allowed to use. Okay, so we are supposed to use this book only, and I have personally seen it. It is a beautiful book. It includes questions also. I'm sure you all must have gotten the access to this book, and it's an amazing book. Okay, I've personally gone through this book, and it's an amazing book. So please use this book for your preparation. Okay, as of now we have completed chapter number 1, which is the regulatory environment from this book, right? So let's go for this chapter. Let's have a quick understanding of what we have covered, and let's see if we have covered everything or is there something left for us to cover. So we discussed about laws, regulations and standards, right? So we discussed about it. We discussed about the regulations as well. We discussed about audit and assurance services as well. We discussed about IFAC as well, recognized supervisory board as well. International standards on auditing of UK and Ireland. We have discussed about that as well. We have discussed about the setter as well. So there are financial action. There's financial action task force on money laundering (FATF), International Accounting Standards Board (IASB), International Auditing and Assurance Standards Board (IAASB). We have discussed about ISBA as well, and we have discussed about OECD as well, right? Then we discussed about the functioning of each one of them. Then we discussed about public interest. So public interest refers to the overall well-being of the community. We have discussed about that as well. Then we discussed about certain bodies, which is in the form of public interest oversight board, public company accounting oversight board, right? We discussed about that as well. When we talk about public interest oversight board, so IFAC established the PIOB in 2005. Okay, and the PIOB oversees IFAC's standard setting activities in auditing, assurance, ethics. When we discussed about public company accounting oversight board, so established by Sarbanes-Oxley Act of 2002. Okay, it's a private non-profit corporation tasked with overseeing auditors of public companies in the United States, right? Okay, then UK Financial Reporting Council is there. Okay, then impact of corporate governance principles on audit and assurance. So we discussed about relationship between corporate governance and audit and assurance practice. So that is there. Now comply or explain versus rules based. So what is comply or explain terminology? So let me explain it to you. Okay, when I say comply or explain, so what do I mean by it is that if you are complying with the rules and regulations, then there's nothing to disclose. However, if you are not complying with the rules and regulations, or if you have not complied with any of the provisions, then you need to explain the reasons for such non-compliance, right? That is the meaning of comply or explain. And when I say rules-based approach, so you have to mention even if you have complied with it. So that's a major difference. Okay, that's a major difference. So in a comply or explain approach, I think we missed out on understanding this yesterday from our workbook. So let's work on this one. So comply or explain. So when I say comply or explain versus rules based, in a comply or explain approach, in a comply or explain approach to corporate governance, what we have to do is regulatory principles are issued. Directors of listed companies are expected to comply with these principles. Disclosures in financial statements demonstrate compliance. Non-compliance, if any, requires clear disclosure and explanation. That is what is the uh, non-compliance about. Okay, that is clearly disclosed here. Then when I say rules-based approach, so what is the rules-based approach? As in, you have to explain everything in detail. Okay, so that is there in rules based approach. Now, importance of a balanced board structure, need for non-executive directors, NEDs, robust procedures for appointing directors and determining their remuneration, merits of audit committees, and need to monitor the effectiveness of system of internal control. That is there. Okay, please give me a second. Okay, now I think it's perfect. Okay, so no worries on that. Now, when I say rules based approach, so what do we mean by rules based approach? So we have to comply every single point that is given. Okay. However, the disclosures are similar. Now, example of Enron was there. Now, main principles of corporate governance. So board leadership and company purpose is there. However, it was not explained in detail in the last book, but the board's responsibilities include. So now board leadership and company per division of responsibility, everything is clearly mentioned over here. So a thriving company is led by a dynamic and efficient board. Board responsibilities includes defining the company's purpose, values, vision, mission, right? Ensuring adequate resources to meet objectives, establishing a framework for prudent and effective controls to assess and manage risk, promoting engagement with shareholders and stakeholders through meetings, ensuring workforce policies align with company values, supporting long-term success and providing a platform for employees to voice concerns. Then division of responsibilities in terms of responsibilities and structure, chair leads to the board and ensures its overall effectiveness, demonstrates objective judgment and fosters a culture of openness, facilitates constructive relation contribution from all non-executive directors. That is very, very important here, right? Okay, then composition, succession, and evaluation. So establish a formal, rigorous, and transparent procedure for board appointments. Implement an effective succession plan for both board and senior management. Nomination committee ensure a majority of independent non-executive directors (NEDs) in the nomination committee. Then merit-based appointments. Base appointments and succession plans on merit and objective criteria. Promote diversity in gender, ethnicity, and personal strengths. Then annual board evaluation. So conduct an annual evaluation assessing composition, diversity, and the board's effectiveness in achieving objectives. Now, audit, risk, and control. So, the board must set clear policies for independent and effective internal and external audits, primarily through an audit committee. Verify the integrity of financial and narrative statements. Provide a fair, balanced, and understandable assessment of the company's position and prospects. Implement risk management procedures and overall internal control frameworks. Define the nature and extent of key risk the company is willing to take for long-term strategic objectives. Then remuneration. In the realm of remuneration, policies should align with the strategy supporting long-term success. Executive remuneration must be linked to company purpose, values, and successful delivery of long-term strategy. Establish a transparent procedure for remuneration policy development, typically through a remuneration committee. Now, guidance on audit committees. Now, guidance on audit committees. So, composition, we have discussed that there should be at least three directors, three members, and two minimum members for smaller companies. All members must be independent non-executive directors. One should have relevant and recent financial experience. Okay, now roles and responsibilities. Monitor the financial statement integrity and review significant financial reporting judgments. Then external auditor selection. So oversee the selection process if recommending new external auditors. Annual report explanation on reappointment process, tendering decisions and rationale. Okay. Now external audit roles and responsibilities. So assessment and reporting is there. Okay. Risk management consideration. So their roles and audit committee's roles and regulation responsibilities towards external audit, approval of engagement terms, review of engagement letter, ensuring auditor independence, audit planning, review of audit findings, review of written representations, management letter review. Then assessing audit effectiveness. So adherence to audit plan, auditor robustness and perceptiveness, feedback gathering, auditor resignation investigation. Now audit quality practice aid. So we discussed about that mindset and culture should be very important. So what are the attributes of a successful auditor or a skillful auditor? So mindset and culture, judgment, quality control, skill, character, and knowledge. Now benefits of audit committee. So ensuring confidence, provide effective oversight for market, public, and stakeholder confidence in high quality financial reporting. Thorough review, enable the board to delegate a comprehensive review of both internal and external audit matters, enhancing external confidence in the entity. Then independent judgment, non-executive directors contribute independent judgment on critical business aspects. Direct link with auditors, so offer external and internal auditors a direct formal link with non-executive directors, fostering effective communication and informal exchanges. Then potential drawbacks of audit committee. So perceived burden, seen as unnecessary legal or regulatory burden, resistance from the board, asserting self-sufficiency. Challenges in finding candidates, so demands and expectation on non-executive directors make finding suitable candidates harder, right? High risk and burden. So risk and responsibilities on committee members might be deemed excessively high because they have to review everything related to auditor, which is a very tough thing. Then cost benefit concern, additional cost may outweigh perceived benefit. That is, there's an additional cost to every analysis that is done by audit committee, and there might not be such benefits derived from such activities. That is very, very important. Okay, so that is very, very important here. Now, effectiveness dependency. So, effectiveness hinges on adherence to governance codes with lacking respect, understanding, and restricted access, diminishing impact. Now let's discuss about chapter number 2, which is money laundering. Now this is a very, very important chapter if we talk about it. Okay, it's a very, very important chapter. So when I say money laundering, so money laundering is what we generally consider, that conversion of black money into white money is money laundering, right? That's it. That's only the money laundering. That if we have converted black money into white money or dirty money into clean money, then it is called as money laundering. But that is not a complete understanding of money laundering. There are multiple adjustments to it. There are multiple additions or deletions from it. Okay, so let's discuss about each one of them. This is a very, very important chapter because anytime you look for triple A paper, you will find that there would be some part of the question that would be asked from money laundering. Generally, it might be asked in um section A, which is 50 marks question. So one part of the question could be related to money laundering. So there might not be a direct question on money laundering. A full case study might not be there on money laundering, but definitely there would be a lot of instances where money laundering would be discussed, and you should know about each aspect of money laundering. That is a very, very important chapter for our syllabus. Okay, so that is why you have to completely understand this chapter in detail, and there should not be any reservations while understanding this chapter because it's a very critical one. Okay, now when we talk about money laundering, so money laundering is the concealment of true origin and ownership of criminal proceedings. Please note down certain points here. First of all, concealment of the true origin. Concealment as in you are hiding the true origin or ownership. So either you are hiding the true origin of the money or ownership of criminal proceeds, enabling control and creating a legitimate cover for sources of income. So you are trying to conceal the true origin, or you are trying to hide the ownership of criminal proceedings, not every proceedings, criminal proceedings, enabling control. See, if you are trying to hide your legitimate income, then it's a tax fraud, nothing more than that, right? But if you have earned money through criminal proceedings, okay, so maybe you are a gangster, maybe you have kidnapped somebody, and then you have earned money, and then you are trying to hide it, then it is called as money laundering, enabling control and creating a legitimate cover for the sources of income. Now, so to gain control over that money, okay. Now, the term money laundering encompasses various activities related to the proceeds of any crime, also known as criminal property. Okay, so what all things are covered under money laundering? Let's understand this. So, possession, dealing, or concealing. Possession. Even if you have not converted that money, even if you have not, even if you are not trying to hide the origin or you are not trying to conceal the fact, but if you are in possession of that kind of a money, then it is called as money laundering. If you are dealing in such a money, if you are helping the processors, so that is also part of the money laundering process. Or concealing, when I say concealing, concealing as in you are trying to hide, so involves possessing, dealing with, or concealing the proceeds of any crime. Now, attempt, conspiracy, or incitement. Attempt, conspiracy, or incitement as in encompasses attempting, conspiring, or inciting to commit such offenses. That is, either you are yourself attempting, or you are part of the conspiracy to commit such a crime, or incitement, you are inducing somebody to commit such a crime, then also it is called as money laundering. Aiding, abetting, counseling, or procuring includes aiding, abetting, counseling, or procuring the commission of such offenses. That is, somebody, you are trying to manipulate somebody into committing this crime, or you are helping them out, or you are counseling them. Criminal property. What is the criminal property? Now let's understand the definition of criminal property, also criminal proceeds also. So criminal property consists of money, securities, tangible and intangible property. It arises from activities like tax evasion, if you are trying to hide tax, bribery, corruption, benefits from criminal cartel operations, and advantages resulting from a criminal failure to comply with regulatory requirements. That is, it could include tax evasion also, if you're trying to hide taxes and you are trying to conceal the origin of the money. Bribery, if certain money is obtained out of bribery, then also it's a money laundering charge. Corruption, money laundering charge. Okay, benefits from criminal cartel operation. A lot of times, a lot of commission is generated via cartel operations, so that is also there. Then bribery related benefits. So benefits obtained through bribery encompass both the receipt of a bribe and income received from a contract acquired through bribery or the promise of a bribe. Right, that is very, very important. Now, FATF. Now, FATF. So, the Financial Action Task Force on Money Laundering, FATF, is an intergovernmental body that sets standards and policies to combat money laundering and terrorist financing. In 1990, FATF introduced the 40 recommendations to address the misuse of financial systems for money laundering during money. Since the first revision in 1996, over 200 jurisdictions have committed to these recommendations, which serve as international anti-money laundering (AML) standards for national AML systems. AML regulators worldwide, such as the Monetary Authority of Singapore, the Financial Intelligence Center, South Africa, and the UK's Financial Conduct Authority, enforce these standards. The recommendations cover. These are recommendations. Okay, it's an intergovernmental body, that is multiple governments are involved here. Okay, they set standards and policies to combat money laundering and terrorist financing. Now, the recommendations include what? Defining the criminal offenses of money laundering, like we have discussed. So, what are criminal offenses? That is clearly defined over here. Okay, then measures for financial institutions and non-financial businesses to prevent money laundering and terrorist financing, including customer due diligence and reporting suspicious transactions to a financial intelligence unit. So, measures for financial institutions and non-financial businesses to prevent money laundering and terrorist financing, including customer due diligence and reporting suspicious transactions to a financial intelligence unit. That is there. Okay, then transparency and disclosure of beneficial ownership in legal entities and arrangements. Sometimes a lot of times what happens is the ownership is different from the beneficial ownership. For example, if I want to hide my ownership of a property, what I'll do is I'll get it registered under somebody else's name, but I'll say that I have the right to collect the rentals or capital appreciation from it. So that could also be there. Then international cooperation, including mutual legal assistance and extradition, might also be there. That is, sometimes if somebody has committed a money laundering offense in India, and for example, they have moved to UK. So now UK government should also help. So there might be certain cooperation agreement regarding that, and it should be clearly uh, made out, and it should be clearly understood and exercised. So that is the recommendation of FATF. Let's understand the recommendations of FATF again. So the recommendations cover defining the criminal offense of money laundering, measures for financial institutions and non-financial businesses to prevent money laundering and terrorist financing, including customer due diligence (CDD) and reporting suspicious transactions to a financial intelligence unit (FIU), transparency and disclosure of beneficial ownership in legal entities and arrangements, international cooperation, including mutual legal assistance and extradition. Now, entry money laundering guidance. So, the entry money laundering guidance for the accountancy sector is a collaborative effort by the Consultative Committee of Accounting Bodies (CCAB) and is issued by ACCA as Technical Fact Sheet 145. Now, reasons for ethical guidance. So, wide scope of offenses. Money laundering offenses have a broad scope, serious consequences. Non-compliance with detailed provision may result in severe legal, regulatory, or professional disciplinary consequences. Then, exercise of professional judgment. So, due to the absence of a clear definition of suspicion, professional judgment is crucial for meeting reporting requirements. Then, confidentiality concerns. So, disclosure requirements may conflict with the fundamental principles of confidentiality. This guidance aims to assist professionals in navigating the complexities of anti-money laundering measures within the accountancy sector. Now, principal offenses. So, the offenses related to anti-money laundering can be categorized into three main types. The offenses related to anti-money laundering can be categorized into three main types. Number one is laundering. Number two is failure to report suspicion, and number three is tipping off. That is very, very important. So, principal offenses. The offenses related to anti-money laundering can be categorized into three main types: laundering, failure to report suspicion, or tipping off. That is, either you are directly involved into money laundering, that is a principal offense, or you are aware about it, or you are suspecting a money laundering offense but you have not reported it, so failure to report suspicion. Or tipping off, that is, come to know about certain investigation against a money launderer and you go and inform them that there is going to be an investigation with the sole purpose of helping them. So that is tipping off. All of these three offenses are principal offenses. So the offenses related to anti-money laundering can be categorized into three main types. Number one is laundering, number two is failure to report suspicion, and number three is tipping off. Generally, it is very, very difficult to say that who has failed to report suspicion, because it is a very subjective matter. Laundering can be proved easily, tipping off can be proved easily based on witnesses and all, but failure to report suspicion is a very difficult one to prove. Now, there are certain stages in which the money laundering happens. So majorly three stages are being defined: placement stage, layering stage, and integration stage. So the laundering of criminal proceeds typically unfolds in three distinct stages. Number one, placement. Number two, layering. And number three, integration. Now, before understanding it in detail, let's have a quick understanding of it. When I say placement, so when the money first enters the financial system. So, for example, somebody has gained certain illegal money, they have introduced it into the formal financial system. Now layering, that the money is converted into multiple forms. So for example, if somebody had say 100 crore rupees, they have introduced it into the financial system. Now what I have done is I have converted into so many layers that it is difficult to track. Okay, and then finally integration, that is I have say launched an IPO and everybody is invested. So there was a beautiful example for this one in one of the South Indian movies called Shivaji the Boss, right? So what he did, he obtained illegal money. He transferred it to offshore locations to multiple people in very nominal denominations. Then he asked that, I'm setting up a foundation. You please invest that money into this foundation. So that is integrating back money into the formal financial system in the form of clean money. Now, placement. So introduction of physical currency into the financial system. Then examples include depositing dirty money in a bank, using it for money orders, or converting into casino gaming chips. Then often the most challenging stage due to heightened suspicion when large sums of cash enter the financial system. Then layering, concealing the origin of illicit funds through a series of complex financial transactions. Then example involve bank-to-bank transfers, domestic and international, and high-value asset transactions like property buying and reselling. Increased layers, making it more difficult to trace the money back to its illegal source. Now, integration. The illegal funds are blended with legitimate funds from lawful commercial activities. Money takes on the appearance of legitimacy, making it challenging to discern its legal or illegal origin. At this stage, the wealth may be indistinguishable as illegal or illegal. Now, example. So there's an example. Okay, but before that, let's read it again and understand each and every line, because that is the most favorite question of triple examiner. Placement. Introduction of physical currency into the formal financial system. Examples include depositing dirty money in a bank, using it for money orders, or converting into casino gaming chips. Often the most challenging stage due to heightened suspicion when large sums of cash enter the financial system, because this is very very important. For example, if I have 1 lakh rupees and if I deposit into bank, I'll have to give my pan, right? That is very very important. It is one of the most difficult stages. Once you cross this stage, then it's easier to move forward. Then layering, concealing the origin of illicit funds through a series of complex financial transactions. So for example, from bank I've transferred to A, then B, then C, then D, and then I've continued till Z. So it's a very complex transaction now to track back from Z that the money has actually been obtained from A. That is very very important. Then examples involve bank-to-bank transfers, domestic and international, and high-value asset transactions like property buying and reselling. Right? Increased layers make it more difficult to trace the money back to its illegal source. Then integration. The illegal funds are blended with legitimate funds from lawful commercial activities. Money takes on the appearance of legitimacy, making it challenging to discern its legal or illegal origin. At this stage, the wealth may be indistinguishable as legal or illegal. Now, example. Danske Bank money laundering scandal. Let's just read it. So, Danske Bank, one of the largest financial institutions in Denmark, was embroiled in a massive money laundering scandal that came to light in 2017. The scandal involved suspicious transactions totaling billions of euros that flowed through Danske Bank Estonian branch between 2007 and 2015. Placement. In the initial stage of the money laundering scheme, illicit funds were placed into the financial system through Danske Bank's Estonian branch. Clients, many of whom were non-residents, made large cash deposits into their account. These deposits, which amounted to billions of euros, raised red flags due to their size and the questionable sources of the funds. Now, layering. Once the illicit funds were within the financial system, they were subjected to layering to conceal their origin and ownership. Danske Bank's Estonian branch facilitated complex transactions involving the movement of funds through multiple accounts and jurisdictions. The bank failed to adequately monitor these transactions or conduct sufficient due diligence to identify and report suspicious activities. Then integration. In the final stage, the laundered funds were integrated back into the legitimate economy. Danske Bank's Estonian branch processed the illicit funds through various channels, including correspondent banking relationships, before ultimately being transferred to accounts held by individuals and entities worldwide. These funds were used to finance a range of activities, including real estate purchases, luxury goods acquisitions, and investments in legitimate businesses. Now, fiscal offenses. So, proceeds from tax evasion can be laundered. Proceeds from tax evasion can be laundered similarly to those from drug trafficking, terrorism or theft. Offenses may involve direct taxes, example income or corporation tax, or indirect tax, example sales tax. Tax evasion offenses qualifying as money laundering include under declaring income and overclaiming expenses. This blurs the distinction between illegal proceeds from tax evasion and other criminal activities within the scope of money laundering. That is very, very important here. Okay. Now let's take a short 2 minutes break and then we will move forward. Okay. Now activity one is there. So money laundering activities are there. Sparkle Company is a national distributor of domestic cleaning products which are bought from wholesalers. The company employs a team of approximately 650 sales staff around the country who sell to both domestic households and small to medium sized businesses. Around 75% of Sparkle companies Sales transactions are cash based, and each sales staff prepares a monthly cash report. To help an entrepreneurial spirit among sales staff, the chief executive officer CEO is encouraging cash sales to friends and family on a commission basis. Leading the way with this scheme, the CEO recently sold products with a value of $35,000 to a business associate. The funds have been transferred directly into an offshore bank account in a Sparkle company's name, on which the CEO is the sole signatory. Now answer. The high level of cash based sales 75% and a high volume of individual sales report 650 into 12 is equal to 7,800 a year creates a significant risk that illicit cash funds are being passed off as legitimate sales. More specifically, the CEO sales to a business associate for $35,000 may be an example of the placement of illegal funds in order to legitimize them as genuine sales. The size of the transactions in a business selling domestic cleaning products and the round sum amount may be additional grounds for suspicion in relation to these transactions. Is this normal? So the involvement of an offshore business arrangement is suspicious as there's not clear business purpose for this. It is also suspicious that the CEO should be the sole signatory to the bank account. A suspicion report should include reporting business's full name, subject identification, name, address, date of birth, nationality, occupation, and employer, subject roles, clarification of each role, example, suspect, victim, unknown, then identification and references, so includes bank account and transaction details, amounts, dates, currencies, sources and estimates, and location of any laundered property. Now tipping off. Now tipping off. So this offense encompasses disclosing a suspicious activity report or investigation to a third party or compromising a confiscation or money laundering inquiry. Professional accountants must report suspicions and seek authorization to proceed to avoid tipping off. Failing to engage in discussions about money laundering matters with clients when necessary may be considered tipping off. Now this is very very important. Let's understand this again. Okay, so this offense encompasses disclosing a suspicious activity report or investigation to a third party. This offense encompasses disclosing a suspicious activity report or investigation to a third party or compromising a confiscation or money laundering inquiry. Professional accountants must report suspicions and seek authorizations to proceed to avoid tipping off. Failing to engage in discussions about money laundering matters with clients when necessary may be considered tipping off. Now penalties. Conviction of offenses may result in conviction of offenses may result in number one, imprisonment. So minimum terms, example 6 months or more. Fines may be unlimited. Combined penalties, both imprisonment and fines may be imposed. Right now, please understand that this offense can combine disclosing a suspicions activity report as well. That is, if you suspect also, then also you have to report or investigation to a third party or compromising a confiscation or money laundering inquiry. See, disclosing what? A suspicious activity report or investigation to a third party or compromising a confiscation or money laundering inquiry. Professional accountant must report suspicions, seek authorizations to proceed to avoid tipping off. That is, it is very, very important that professional accountant must report suspicions. Okay. Now liability. So partners and directors, all partners in a practice and directors in a firm bear potential joint and several liability for breaches of the firm's obligation. That is, if you are a partner or a director, so every partner or director in a firm bears joint and several liability. It is very very important. Then now individual liability. Every individual is liable for breaches of their specific obligations. Now, additional risk. So, loss of business authority, risk of losing the authority to conduct business, impacting both the business and individuals. Then, advertised publicity. So, exposure to negative public attention, loss of reputation, potential harm to the business and individual reputations, global reputation protection. Implementation of a comprehensive AML strategy is advisable for a UK business to safeguard its global reputation alongside its UK regulated operations. Then general defenses. Defenses against money laundering offenses include what could be the defense that could be made. So reports made. A report has been submitted to the appropriate authorities or the money laundering reporting officer as per section 3.3. So it is very, very important that if you can prove that you have submitted the relevant report to the appropriate authorities or the money laundering reporting officer inside your company, then it is a valid defense. Then intention to report, intent to make a report existed, but there was reasonable excuse for not doing so. That is, you wanted to make a report and submit it, but there was a reason. Maybe you were involved in highlighting the issues, maybe you were involved in quantifying the issues, and it was not possible. Now, client action in good faith. So the client's acquisition or use of property was believed to be in good faith and for adequate consideration. That is, whatever you have done in good faith, and you have provided the reasonable explanation, and you have provided the reasonable consideration also. So, for example, uh, if you were found in possession of the criminal property, but it was later found out that you obtained it in good faith, you didn't know that it was a criminal property, then it is a general defense. Now, defenses against money laundering offenses include what? Number one, report made. So, a report has been submitted to the appropriate authorities or the money laundering reporting officer (MLRO) as per section 3.3. Then, intention to report. Intent to make a report existed, but there was a reasonable excuse for not doing so. Then, client action in good faith. So, the client's acquisition or use of property was believed to be in good faith and for adequate consideration. Now, professional duty of confidence. So, statutory provisions offer protection against criminal action for professional accountants concerning confidentiality requirements. However, client confidentiality can be overridden under the following condition. So, statutory provisions offer protection against criminal action for professional accountants concerning confidentiality requirement. That is, if they have reported money laundering offenses, then they will not be subject to the confidentiality uh, compromise. Punishment. That is, client cannot say that they were bound by confidentiality, still they have disclosed it. So statutory provisions offer protection against criminal action for professional accountants concerning confidentiality requirements. However, client confidentiality can be overridden under the following conditions. So number one, money laundering offense. So when there's a knowledge, suspicion, or reasonable grounds to believe that a person has committed a money laundering offense. And number two, prohibited act. So if there's knowledge, suspicion, or reasonable grounds to believe that a prohibited act will be or has been committed. Now, disclosure without reasonable grounds for knowledge or suspicion may increase the risk of a professional accountant being sued for breach of confidentiality. Now, legal privilege. So, privilege refers to the right of an individual or entity to seek advice from lawyers regarding their legal position and to have the confidentiality and privacy of those consultations respected. This privilege safeguards the open and uninhibited communication between clients and their legal representatives. Legal privilege can serve as a defense for professional legal advisors such as lawyers, solicitors, and barristers facing charges for failing to report suspicions of money laundering. However, this privilege applies under specific conditions. Now, privileged circumstances. So, the information must be received in circumstances protected by legal privilege, non criminal intent. So, the information should be communicated to or by the lawyer with the intention of furthering a criminal purpose. It's important to note that legal privilege does not extend to discussions between professional accountants and their clients. Accountants are obliged to report all suspicions of money laundering. That is, legal privilege is given to lawyers for all communication done between them and their client, but such privilege is not given to accountants. That is, accountants are required to report all money laundering offenses that are there. Otherwise, it would be considered as being part of the fraud, or even can be considered as tipping off. Okay. Now, requirements for money laundering prevention. Okay, requirements for money laundering prevention. So, establishing AML culture. AML as an anti-money laundering culture. So, requirements for money laundering prevention. So, establishing AML culture. Develop a top-down anti-money laundering AML culture integrated throughout the entire organization. Then implementing risk management. So, establish risk management procedures, internal controls, and policies for efficient compliance with legislation. Okay, so AML culture, anti-money laundering culture should be established by the person implementing risk management, that is identifying the right risk, maintaining sufficient internal controls. Then appointment of MLRO, that is MLRO should be appointed. So appoint a money laundering reporting officer at a senior level to whom all suspicions of money laundering should be reported. Then key partner responsibility. So designate a key partner to be responsible for risk management and internal controls, and that is why there's a risk management committee also in a listed company. Then record keeping system should be appropriate. So implement system for comprehensive record keeping of all transactions. Then client verification and monitoring. So maintain systems for initial verification and continuous monitoring of clients' identities, transactions, and activities. Then internal reporting procedures, to establish internal procedure for reporting suspicions. Now staff education and training, so educate and train all staff on the main requirements of relevant legislation. In jurisdictions like the UK, non-compliance with these obligations is an offense, and failure to comply can result in severe penalties. Now, risk management, internal controls and policies. Risk management, internal controls and policies. Risk-based approach. Identify relevant money laundering and terrorist financing risk in the professional accountant's business. Design and implement controls to manage and mitigate these risks, recording their operations. Then examples of risk. Clients using services to launder assets, offering products susceptible to money laundering, types of clients and industry sectors, jurisdictions of client origin and operation, client funding, investment, business activities, reputation, contacts, and public profile. Then establish internal controls and policies. So align controls and policies with perceived risk, cover client due diligence, ensure reporting procedures for suspicions to the money laundering reporting officer MLRO. Now client acceptance procedures. So include identification processes, gather know your client KYC information. Now controls over client money and transactions. So focus on client identity, evaluate the commercial purpose of transaction, scrutinize the source and destination of funds. Now, money laundering reporting officer. So the MLRO should possess an appropriate level of seniority and experience. The MLRO should possess an appropriate level of seniority and experience. That is, it should not be a person who is new to the profession. They should have the appropriate level of seniority as well as experience to understand that what are money laundering offenses, how to proceed with money laundering offenses, how what are their responsibilities. They should be well versed with functioning independently. Now, potentially being one of the principals of an accounting firm. That is, they are to be and they should be of a partner level. Now, responsibilities of the MLRO. So evaluate internal reports of money laundering. That is, if somebody has reported something on the money laundering part internally, then they have to evaluate how much of it is true. Are there any action needs to that are required to be taken? Then determine if there are sufficient grounds for suspicion. That is, based on that information, they have to evaluate that if there are sufficient grounds for suspicion. If yes, they should have the investigation done. If not, then they have to close the report. Then prepare suspicious activity report. That is, they have to prepare an activity report where they have to mention or disclose about their actions, when even when they are ignoring for certain reasons, or if they are taking action, then result of those actions and all. Then lies with authorities on consent and disclosure matters. That is, you should do the liaison with the relevant regulatory authorities for the disclosure matters. Then additional MLRO responsibilities: provide training on AML, anti money laundering and SAR procedures for firm employees, advice on preventing risk of tipping off or prejudicing investigations, design and implement internal AML systems and procedures. Note: a sole practitioner without employees or associates may not require an MLRO. Now, record keeping. So, record keeping requirements for anti-money laundering AML compliance are as follows. Number one, client identification and business records. So, maintain client identification records, business relationship details, and transaction monitoring records in a comprehensive audit trail. Then, transaction record retention. So, keep transaction records readily retrievable for a minimum of 5 years after the completion of the last transaction or the termination of the business relationship. Then, access controls. Implement controls to prevent record destruction until the 5 year retention period is satisfied for all users if accessed by multiple departments or individuals. And client verification records. So retain client verification records throughout the relationship and for 5 years post termination also. Now, retention of MLRO reports. Retention of MLRO reports. So, preserve all internal and external reports and actions taken by the Money Laundering Reporting Officer (MLRO) for at least 5 years from the date of MLRO resolution. That is, they should retain all the reports for at least 5 years from the date of resolution, not from the date of reporting, but from the date of resolution. Then ACCA rules of professional conduct. So, other to ACCA rules of professional conduct, especially retention of book, files, working papers, and other documents, because that is very, very critical. Now, what we have to read: customer due diligence we have to understand. Then we have to understand after this suspicion, education and training, resignation, interaction of reporting duties, principles, and then we will be done with this chapter. Okay, so I think it's a good time to take a 15 minutes break. Then we'll come back and we will discuss about customer diligence. So it's 2:40. Let's come back by 2:30. Okay, now let's start studying about customer due diligence. So, what is customer due diligence? So, customer due diligence involves taking steps to identify customers and verifying that they are who they claim to be. Okay, so that is like a KYC procedure that is being conducted by various apps, by various institutions, right? That's a KYC kind of thing. What we need to do is need to do a customer due diligence. So this process typically includes thorough checks and assessments to ensure the legitimacy of customer identities and to prevent fraudulent activities. So, for example, if somebody has placed an order, so you should obtain their relevant registration documents. You should verify that whatever the certifications are there, are they valid or not? Are they expired? And things like that. So this process typically includes thorough checks and assessments to ensure the legitimacy of customer identities and to prevent fraudulent activities, money laundering or other illicit actions. CDD is a fundamental practice in various industries to establish a secure and trustworthy business relationship with customers. Customer due diligence (CDD), also known as Know Your Customer (KYC), ensures that professional accountants, client identification, know who their clients are, avoid accepting clients outside the firm's risk tolerance or whose business lacks sufficient clarity to form money laundering suspicions when necessary. CDD application applies CDD including KYC to all clients, both new and existing. CDD occasions conduct CDD when establishing a business relationship, carrying out occasional transactions, suspecting money laundering or terrorist financing, doubting the accuracy and reliability of previous identification information. Then before business relationship. So before entering a business relationship, the professional accountant must identify and verify the client's identity using reliable and independent sources, identify any beneficial owner not considered the client, obtain information on the purpose and intended nature of the business relationship. Now, client identification, knowing your client. So client identification or knowing your client is crucial in managing the risk of money laundering. The level of detail required depends on the risk associated with the client. Higher the risk, more would be the information. So for individuals with normal risk, essential document includes a photo ID such as driving license or passport, along with a recent utility bill confirming the full name and permanent address. So driving license or passport is there, and recent utility bill like electricity bill, water bill, right? Confirming the full name and address. Now, for entities with normal risk, refer to the registrar of companies for key documents. So based on risk, if the risk is nominal, you can obtain identity card, you can obtain address proof, and then you are done. But when there's a normal risk that is higher than lower risk, then or when for individuals it is there, for entities with normal risk you should obtain registrar of, you should verify with registrar of companies, right? So you should obtain certification documents, you can obtain annual returns filed with the ROC, now including the certificate of incorporation, registered address, and a list of shareholders and directors. An example, State Bank of India KYC norms. Okay, so we all have done KYC in some of the other banks. So let's just read the list of it. Account opening process. So when individuals or businesses open accounts with SBI, they are required to provide various documents and information as per the bank's KYC requirements. This typically includes proof of identity such as Aadhaar card, passport, or driver's license, proof of address such as utility bills or rental agreement, and recent passport sized photographs. Verification procedures. So SBI verifies the documents provided by customers to ensure their authenticity and compliance with regulatory standards. This may involve cross-checking information with government databases or conducting in-person verification at SBI branches. Now, risk categorization. So SBI assigns risk categories to its customers based on factors such as their occupation, income level, and transaction history. Higher risk customers may undergo enhanced due diligence procedures to mitigate potential risk associated with money laundering or terrorist financing activities. Then, transaction monitoring. So, SBI monitors customer transactions for any unusual or suspicious activity that may indicate potential fraud or illicit financial activities. This includes large cash deposits or withdrawals, frequent international transactions, or patterns inconsistent with a customer's usual behavior. Then periodic review and updating. So SBI conducts periodic reviews of customer information to ensure its accuracy and relevance. Customer may be required to update their KYC information at regular intervals or in case of significant changes to their personal or financial circumstances. Now, compliance reporting. SBI is obligated to report any suspicious transactions or activities to the appropriate regulatory authorities, such as the Financial Intelligence Unit India (FIU) in IND. as per the provisions of the Prevention of Money Laundering Act (PMLA) and other relevant regulations. By implementing robust KYC norms, SBI aims to enhance the security and integrity of its banking operations, safeguard customer interest, and comply with regulatory requirements aimed at preventing financial crimes. Now, suspicion or recognition. So, suspicion in the context of transactions is challenging to precisely define. Typically, a suspicious transaction or situation arises when it deviates from a client's established legitimate business or personal activities. The cornerstone for recognizing suspicion lies in the principles of KYC. Examples of potentially suspicious transactions encompass unusually large cash deposits, frequent conversion of cash into other currencies, transactions with an unknown counterparty, activities inconsistent with the normal business patterns, involvement in offshore business arrangements lacking a clear business purpose, then reporting. So, professional accountants are mandated by law to report any knowledge or suspicions of money laundering to the relevant authority, such as the MLRO, police, or customs officer. Non-compliance constitutes a criminal offense with no exemptions based on the amount involved or the severity of the offense. Reporting obligation persists regardless. In cases where a client proposes an action that may constitute a money laundering offense, a written request for consent must be submitted to the appropriate authority. No action, potentially offensive, should be taken for 7 working days unless consent is granted. Immediate legal advice is essential. If no response is received within 7 days, consent is presumed, allowing the professional accountant to proceed. Now, education and training. So, education and training for relevant individuals is essential and should cover reporting procedures to the MLRO, client identification methods, recognition and handling of situations related to money laundering, understanding the main money laundering offenses, familiarity with the business's anti-money laundering procedures, including identification, record keeping, and reporting protocols. Now, the training serves to establish a culture of compliance within the organization, be documented to demonstrate adherence to compliance standards, and effective training methods may include attendance at conferences, seminars, and courses conducted by external organizations, participation in computer-based training courses and webinars. Do you need to remember all of this? No. You need to understand that these could be certain sources and this could be certain objectives of training programs. Nothing more than that. Okay. Then resignation. A business has the discretion to resign from representing a client under the following circumstances. That is, a business could deny to represent a client under following circumstances. Number one, when the business believes that continuing representation is not in commercial interest, that is, it's not commercially viable to represent the client because of the fees related issues or the cost benefit analysis, or when continued business representation would be inconsistent with professional or ethical requirements. That is, it is not as it will be considered as non-compliance of professional ethical requirements if you continue representing a client. Okay. Now, when resigning, precautions must be taken to avoid tipping off of the client. Okay, that is, whenever you're resigning, you cannot go and report all the suspicion activities of a client. Seeking legal advice is recommended if there's any uncertainty in the process. Now, interaction of reporting duties. So, accounting firms and others have additional reporting duties beyond reporting suspicions to the appropriate authority, subject to different standards. These may include: number one, reports to regulators; number two, auditors reports on financial statements. Example, ISS 705 on modifications to the opinion in the independent auditors report. Then reports to those charged with governance. ISA 260 on communication with those charged with governance. Then a statement of circumstances upon resigning as an auditor. Now, reports on directors' conduct. Example, under the Company Directors Disqualification Act 1986 in the UK. Members of professional bodies may also be required to report misconduct by fellow members. Okay. It's important to note that in some cases, the substance of the matter reported to the appropriate authority may not need to be disclosed in other reports. For instance, auditors' reports typically focus only on material matters, whereas there's no de minimis limit for reporting money laundering matters. That is, there's no minimum limit. Okay, now let's understand this line by line. So, accounting firms and others have additional reporting duties beyond reporting suspicions to the appropriate authority, subject to different standards. These may include These may include number one, reports to regulators. That is, you might have to report to the relevant regulator besides reporting to appropriate authority. Then auditors reports on financial statements, they have to report this report. Also auditors report on financial statement. Then reports to those charged with governance also needs to be issued. Then a statement of circumstances also needs to be issued upon resigning as an auditor. Then reports on directors conduct should also be issued. Now members of professional bodies may also be required to report misconduct by fellow members. It's important to note that in some cases the substance of the matter reported to appropriate authority may not need be disclosed in other reports. For instance, auditors report typically focus only on material matters, whereas there's no de minimis limit for reporting money laundering matters. Now, principles. So, obtaining consent to tip off is not feasible. Firms should collaborate with the relevant investigating authority to finalize the wording of other reports. Even when reports are not intended for client publication, caution is needed to prevent tipping off. If a compromise cannot be achieved between reporting duties and avoiding tipping off, firms should safeguard themselves by seeking legal advice. That is, if you want to report something which might be considered as tipping off, then it is very, very bad, and you should not take decision yourself. You should seek legal advice, or you should seek directions from a court of law. Let's read it again. So obtaining consent to tip off is not feasible. Firms should collaborate with a relevant investigating authority to finalize the wording of other reports. Even when reports are not intended for client publication, caution is needed to prevent the tipping off. If a compromise cannot be achieved between reporting duties and avoiding tipping off, firms should safeguard themselves by seeking legal advice or seeking directions from a court of law. Now, professional clearance letters. So, when suspicion has been or may be reported, caution is advised in responding to professional clearance letters. Businesses and individuals should refrain from answering questions in professional clearance letters regarding satisfaction with the identity of an entity or individual, whether any report of suspicion has been made or contemplated. Now, basic elements of anti-money laundering program. Basic elements of anti-money laundering program. So when crafting an AML program, essential elements to consider include, when crafting an AML anti-money laundering program, essential elements to consider include number one, dedicated resources. That is, there should be certain dedicated resources only for the purpose of maintaining documents and uh, preventing money laundering. So allocate specific roles such as the money laundering reporting officer MLRO to oversee the program. Then written policies and procedures. Establish clear and documented guidelines to guide AML efforts. Then comprehensive coverage. Place emphasis on customer due diligence CDD and know your customer KYC guidelines to ensure thorough coverage. Then timely escalation and resolution. So implement processes for prompt handling and resolution of AML related matters. Then explicit management support. So foster a strong tone at the top with visible and committed support from top level management. Then sufficient training and education. So provide adequate training to ensure that relevant individuals understand and adhere to AML protocols. Then regular review or audit. So conduct periodic reviews and audits of the AML program to confirm its effectiveness and alignment with the designed framework. Now written policies and procedures. Written policies and procedures. Now, written policies and procedures. So, need for written procedures must identify risk factors indicating potential money laundering activity. Then, risk factors, account holder actions indicating potential money laundering. Now, action and example. So, action, secrecy association and example, booking transactions under another person's name. Then, routing through risky jurisdictions. So, directing transactions through jurisdictions with weak customer identification practices. Then unexplained cross jurisdictional transactions. So routing transactions through multiple jurisdictions without clear purpose, aiming to disguise funds. Then frequent or excessive fund or wire transfers. So unusually frequent or excessive funds wire transfer in or out of an account. Then inadequate information in wire transfers lacking information on the beneficial owner or originator when expected. Large currency or bearer instrument transactions, significant transactions involving cash or gold coins. Then repeated or near threshold deposits withdrawal. So regular deposits or withdrawal just below monitoring threshold, especially on the same day. Then high value transactions are misaligned with legitimacy. So large deposits or withdrawals inconsistent with documented information about the account holder's legitimate wealth or business. Now, timely escalation and resolution. Timely escalation and resolution. So reports on suspicious activity must follow timeliness, that is be generated promptly. review levels, undergo suitable levels of review and resolution clarity that is clearly specify the resolution of identified issues. With this, we have completed chapter number 2 as well. Now, let's go and check that what chapter we are going to study next. So the next chapter that we are going to study is Code of Ethics for Professional Accountants. Code of Ethics for Professional Accountants. We will not be able to complete it today, but we will have a good understanding of it. Okay. So let's understand this one, Code of Ethics for Professional Accountants. This is very, very important. As of now, we have completed chapter number 1, which is regulatory environment, and chapter number 2, which is money laundering. In this book, there would be, if you compare number wise, there would be few more chapters. Okay, the content is same. See professional responsibility and liability, quality management, professional appointments, planning, materiality and risk, evidence and testing, audit procedures and obtaining evidence, using the work of others, group audits, completion and review, auditor's report, communicating with those charged with governance, audit related and assurance services, reviews and related services, prospective financial information, forensic audits, social, environmental, sustainability and integrated reporting, audit in the public sector, current issues and developments. Everything is similar. Only thing is that only thing is that the number of chapters have been divided into separate parts, and that is why there are 21 chapters instead of 16. Okay, so now we are going for the new chapter, which is Code of Ethics and for professional accountants. Okay, let's take a 2-3 minutes break and then we will start with this chapter. Okay, now chapter number three, which is Code of Ethics for Professional Accountants. So, number one, we have discussed that fundamental principles of ethics yesterday. We have discussed about the threats also, and that's what we are going to throw a lot of light on in this chapter. Okay, so now purpose of professional codes. So, professional code serves three primary purposes. Whenever we talk about any of the professional codes, so they serve three primary purposes. Number one, guide professional accountants in maintaining a proper attitude and elevating the accountancy profession. Number two, establish accountability to the public. And number three, codify behavior beyond legal requirement. Now, that might be an important question, so please remember it. At this point, you need to remember they guide professional accountants, okay, in maintaining a proper attitude, establish accountability. So, first point, guide. Second point, accountability. And number third point is codify behavior beyond legal requirements. That is, they give the proper code of conduct. Okay. Now, ISBA International Code of Ethics for Professional Accountants. So, introduction. The ISBA International Code of Ethics for Professional Accountant issued by IFAC, this we have understood, emphasizes that member bodies, example ACCA, in India ICI is also there, bear the responsibility for number one, crafting detailed ethical requirements. So, ACCA should create a detailed ethical requirements, ICI should create a detailed ethical requirements, and similarly, other professional bodies should also create a relevant ethical requirements, executing and enforcing these requirements. That is not just craft, but you ensure that it is enforced also at the ground level. That is, it is being followed appropriate. It is being followed appropriately or not. As an IFAC committee, ISBA develops and issues the International Code of Ethics, serving as a model for IFAC member bodies. This code establishes standards of conduct and outlines fundamental principles as the foundation for minimum ethical requirements. Now, objectives of the accountancy profession. Objectives of the accountancy profession. So, highest standards of professionalism, strive for excellence and professional conduct, highest level of performance, aim to achieve top tier performance standards, and meet public interest requirements, act in a manner that serves the public interest. Now, these objectives necessitate addressing four fundamental needs. Number one, credibility. Ensure the reliability of information and information systems provided by professional accountants. Professionalism. Identify individuals in the accountancy field as true professionals for clients, employers, and other stakeholders. And number three, quality of services. Assure that all services from professional accountants adhere to the highest performance standards. Confidence. Uphold confidence through a framework of professional ethics governing service provision. Now, ISBA International Code. So, the ISBA International Code is structured on a conceptual framework and comprises four main parts: complying with the code, fundamental principles, and conceptual framework; outlines requirements and application material for adherence to the code's fundamental principle. Okay. Professional accountants in business, so focuses on guidelines relevant to accountants in business. Then professional accountants in public practice, so provides specific considerations for accountants practicing in the public domain. Then international independence standards address standards related to professional independence. Now, introduction to ACCA Code of Ethics and Conduct, ACCA code. So all members and students of the association, regardless of their professional domain, practice, commerce, internal audit, etc., are obligated to uphold proper standards of professional conduct and avoid misconduct. Non-compliance may lead to disciplinary proceedings. Now, fundamental principles. Now, this is very important. So, the ACCA Code 2022 has updated the fundamental principles in alignment with the ISBA Code to enhance the role and mindset expected of accountants. The revisions aim to, number one, principles reinforcement, aim to do principles reinforcement, so it's strengthening the principles of integrity, objectivity, and professional behavior. Then inquiring mindset, so they want to develop a mindset of inquiry. A professional skepticism needs to be developed here, so elevating behavioral expectation, urging all professional accountants to maintain an inquiring mind. Then bias awareness, so emphasizing the importance of being aware of potential biases. Then organizational culture, so highlighting the supportive role of organizational culture in fostering ethical conduct and business. Now, integrity. In all professional, business, personal, and financial relationships, the professional accountant must be straightforward and honest. This involves fair dealing, truthfulness, and the strength of character to act appropriately, even under pressure or when facing potential adverse consequences. This includes standing firm in dilemmas and challenging others when necessary. Now, objectivity. So the exercise of professional or business judgments by the accountant must remain uncompromised by bias, conflict of interest, or undue influence from individuals, organizations, technology, or other factors. Professional competence and due care. Professional accountant must acquire and uphold professional knowledge and skill to relevant legislation, act diligently and adhere to applicable technical and professional standards, maintain ongoing awareness of relevant technical, professional, business, and technology related developments. Now, confidentiality. Information obtained in professional and business relationships with current, past, or potential clients and employers is confidential. It must not be disclosed without proper authority except when legally or professionally mandated. Example, suspicion of money laundering. Now, authorized disclosure. Only disclosed with explicit authority or legal or professional obligation. Then non-exploitation. So do not use confidential information for personal or third-party advantage. Then vigilance. Be cautious about inadvertent disclosure, especially in social settings or with close associates. Okay. Now, professional behavior. So, adherent to all applicable laws and regulations is imperative, and actions that may bring disrepute to the profession as perceived by a reasonable and informed third party. That is, you should not involve into any activities which can bring disrepute to the profession should be avoided. Notably, the ISBA's revision emphasized the obligation to behave in a manner consistent with the profession's responsibility to act in the public interest. Specific details regarding engagement quality review or objectives in the ACCA Code 2022 and ISBA Code 2022 revisions can be found in Section 3.3 of Chapter 5. These revisions underscore the commitment to maintaining high standards and acting in the public interest with the accountancy profession. Right. So let's discuss about five again. So five fundamental principles are integrity, objectivity, confidentiality, professional competence in due care, and finally professional behavior. Right. Here there are only four mentioned. Okay. Now conceptual framework approach. Conceptual framework says that you should identify the threats, you should evaluate the threats, and you should address the threats. Okay. That is very, very important. Okay. Now to identify the threats, exercise professional judgment. To evaluate the threats, have an inquiring mind, and to address the threat, use the reasonable and informed third party test. Now the framework empowers professional accountants to assess the risk they encounter and align them with suitable actions. It differs from rigid rules, providing flexibility when perceived threats. When perceived threats pose a risk beyond an acceptable level, the professional accountant is obligated to introduce safeguards. These safeguards aim to eliminate either or mitigate the threats to an acceptable level, ensuring the preservation of compliance with fundamental principles is not compromised. This adaptive approach enables accountants to navigate complex situations while upholding ethical standards. Now, acceptable level. An acceptable level is defined as a threshold at which a reasonable and informed third party would likely conclude that the professional accountant is in compliance with the fundamental principles. The framework is to be consistently applied to specific circumstances. If a situation doesn't align with any illustrated examples in the application materials, a guiding principle is if in doubt, avoid. Do not do. That is, if you are in doubt that whether you should do it or not, whether it is ethically viable, ethically followed or not, then you should not do it. In other words, the absence of explicit prohibition does not imply permission. That is, if it is mentioned that until so if you are having the opinion that it is not prohibited somewhere so we can do it, that's not true. Sometimes it is not mentioned expressly, but when you look at the situation you realize that you should not do it in a particular scenario, so you should not do it. So if in doubt, avoid. Do not do it. In other words, the absence of explicit prohibition does not imply permission. Caution should prevail in uncertain situations. Now, activity 1, advantages of the principles based approach. So suggest three advantages of the principles based approach to laying down a code of ethics. Answer: detailed rules encourage avoidance, but principles encourage compliance. A principles based approach is more adaptable to meet any new potential conflicts and threats to independence. It encourages firms to analyze threats to independence rather than to adopt a tick box based approach. It places greater responsibility on the firms to deal with threats to independence. It improves self regulation of the profession by adopting a tougher stance. Now, inquiring mind. So the ISBA's revisions, transitioning from Remain Alert 2018 to Have an Inquiring Mind 2021, signify an elevated expectation. This shift underscores the necessity for professional accountants to actively seek and understand known facts and circumstances crucial for the effective application of the framework. Now, bias. The ISBA's revisions incorporate consideration of bias when applying the framework. Notable biases include there are multiple biases, so anchoring bias is there, automation bias is there, availability bias is there, confirmation bias is there, groupthink is there, overconfidence bias is there, representation bias is there, and selective perception is there. Do you need to mug up all of this? Definitely not. Anchoring bias, but you should have an idea that what are they individually. So you should know the meaning of anchoring bias, automation bias. Now, and if you can remember it, it's even better. Now, anchoring bias. So inadequate assessment due to reliance on an initial piece of information is an anchor. That is, you have gained an initial piece of information and you are relying solely on that. You are not evaluating any other information. That is called as anchoring bias. So how it is defined? Inadequate assessment due to reliance on an initial piece of information as an anchor. Then automation bias. Automation bias, preferring automated output despite questioning its reliability or suitability. That is, if there's an automated system to do something, say if there's a biometric system for attendance, you are relying solely on that. Even if you have reasons to believe that it is not working efficiently, but you are still saying that it's an automated procedure, it's good, right? So preferring automated output despite questioning its reliability or suitability. Then availability bias, so giving more weight to readily available information than less accessible data. That is, what you are doing is whatever is easily available, whatever information is easily available, you are giving more weight to that information, and you are saying that the information which is difficult to obtain might not be more reliable. So giving more weight to readily available information than less accessible data. Then confirmation bias, prioritizing information that supports existing beliefs over contradictory data. Prioritizing information that supports existing beliefs over contradictory data. That is confirmation bias. That is, whatever things or whatever conclusions are supporting or confirming your existing beliefs, you are relying on those and you are thinking that it is better evaluation than others. So for example, if something is challenging your belief and something is accepting or confirming that belief, then you are going for the second one, which is confirming your belief. So you are not behaving rationally, but you have your preconceived notions, and then whatever information is aligned with it, you are relying more on that information. So prioritizing information that supports existing beliefs over contradictory data. Then groupthink, so reaching consensus without critical reasoning or exploring alternatives in a group setting. So reaching consensus without critical reasoning or exploring alternatives in a group setting. That is, they are saying that whatever majority is saying, we have to do that. So they are taking the decision in group in spite of taking consensus, in spite of having a rational discussion. So reaching consensus without critical reasoning or exploring alternatives in a group setting. Then overconfidence bias, so overestimating one's ability to make accurate judgments or decisions. That is, what they are doing is they are saying that whatever this person is going to decide, it's going to be correct only. That is, they are overestimating somebody's capability of making a decision. That is very, very important here. So reaching consensus without critical reasoning or exploring alternatives in a group setting. Now so overestimating one's ability to make accurate judgments or decision. Overestimating one's ability to make accurate judgments or decision. Then representation bias, so basing understanding on assumed representative patterns of experiences, events, or beliefs. Basing understanding on assumed representative patterns of experiences, events, or beliefs. Then selective perception, so allowing personal expectations to influence how a matter or a person is perceived. Then actions to mitigate bias effects include Actions to mitigate bias effects include seeking advice from experts for additional input, consulting with others to ensure appropriate challenge in the evaluation process, receiving training on bias identification as part of professional development. Now, organizational culture. So, the ISBA's revision acknowledge that the effective application of the framework is strengthened when the accountant's organization fosters an ethical culture. Key contributors to this culture include leadership, education, and training initiatives, and the implementation of whistleblowing policies and procedures. Now, conceptual framework threats categories. Compliance with fundamental principles may face potential threats from diverse circumstances falling into the following categories. Number one, self-interest. So, arises from financial or other interest of members or close family members. Self-review threat, we have understood this. Advocacy threat, familiarity threat, and intimidation threat. So, when I say self-interest threat, so it arises from financial or other interest of members or close family members. That is when you yourself are invested in some process, entity, transaction, be it financial or other investment, or your close family members are invested either financially or other investments, then this creates a self-interest threat. So, for example, if you are invested in a company for say 10 lakh rupees, okay, it's a big amount for you, considering it's a big amount for you, and now you are auditing it. There might be a scenario that if something goes wrong with that company, then you have a feeling that your money will also be um lost. So what you do is you do not report it. There might be a chance to that. So that is why self-interest threat. Then self-review threat. You are evaluating the work done either by you or by your uh, subordinate only. So occurs when a professional accountant fails to appropriately evaluate prior judgments or activities relied upon in the current context. That is when preparer and checker are not different. Then advocacy emerges when when you promote the ideas of a client to the level that it becomes your ideas, or it is conveyed in the form that they are your beliefs. So emerges when a professional accountant overly promotes a client's or employer's position, compromising subsequent objectivity. Then familiarity, that is you are known, you have a long standing relationship with somebody from the client side. So arises when a long or close relationship makes a professional accountant excessively sympathetic to a client or employer, risking insufficient application of professional skepticism. Then intimidation is very very important. That is when you are working under undue influence. So occurs when threats, whether actual or perceived, direct or indirect, deter the professional accountant from acting objectively. Okay, now there's a concept. Okay, so you can solve the activity yourself. Now there's a concept of addressing threats. There's a concept of addressing threats. Let's complete it. So mitigate threats effectively, consider the following approaches. Number one, eliminate circumstances. That is, you can either eliminate the circumstances, right, which is giving you a threat. So for example, if you are invested, so you can divest your investment. If you have prepared the work, you can get it reviewed by somebody else. If there's an intimidation threat, you can remove yourself. If there's a familiarity threat, you can employ some other person to review the work or do the work only, right? So remove the advocacy threat, then you can stop promoting the ideas. So remove the condition, interest, or relationship generating the threats. Then apply safeguards. Sometimes you cannot resolve it completely, so what you should do is you should apply safeguards. That is, whatever work you do, it will be reviewed by an independent party also in case of self review threat. So implement available and effective safeguards to reduce threat to an acceptable level. Then decline or end activity. So consider discontinuing the specific professional activity if threats cannot be sufficiently eliminated or reduced through safeguards. Then safeguards refer to actions, whether taken individually or in combination by the professional accountant. These actions aim to effectively eliminate threats to compliance with fundamental principles or reduce them to an acceptable level. Now, key points on safeguards. So, active professional accountant involvement. A safeguard must involve an action by the professional accountant, not merely a consideration. A safeguard must involve an action by the professional accountant, not merely a consideration. Then, distinct from evaluative actions. So, actions involved in evaluating ethical threats, example, seeking advice from a third party, may not inherently be safeguards. A distinct safeguard action may still be required based on the evaluation. And then effectiveness requirements. So the professional accountant's action qualifies as a safeguard only if it is effective in eliminating or reducing threats to an acceptable level. Okay. Now, after this, let's take a break. Then we'll go for conceptual framework, which is professional skepticism. So it's 3:18. Let's come back by 3:30 to 3:32. Okay. Thank you. Okay, now let's go for conceptual framework, that is professional skepticism. So what is professional skepticism? Professional skepticism is an attribute of an author to keep a professional, to have a questioning mind, and be alert to situation that could pose a possible misstatements plus critical examination of evidences. So these three items: have a questioning mind, being alert to situation that could pose a possible misstatements, and third one is critical evaluation of evidences. Okay, now in auditing, the ISA has mandated auditors to exercise professional judgment and uphold professional skepticism throughout the audit process. Independence encompasses two facets. Number one, independence of mind and independence in appearance. Now, these are two different terms. I'll give you example of both. Okay, because this is very, very critical. You should remember that independence should not be only of appearance, but should be of mind as well. Whatever fundamental principles of ethics we are following, whatever threats we are trying to avoid or safeguard, that is only to maintain one thing, which is independence. Okay, and independence of is of two types: independence of mind and independence in appearance. For example, if I've said that, me and my close relative have not invested in a particular company, but my very close cousin is there who has invested in a company. Okay, now if somebody checks my records, they'll never find me or my close relative invested in that company. But my one of my very close cousins who has grown up with me has invested, and I am personally very connected to him. I don't want him to incur any losses. Now, do you think I would be independent do you think I would be independent in appearance? Yes. Do you think I would be independent in mind? No, because if anything goes wrong with the company, I would be willing to say that, I don't want him to incur any losses. I might not be independent there, right? So that is very, very important. Now, independence of mind. So allows the expression of a conclusion unaffected by compromising compromising professional judgment, enables individuals to act with integrity and exercise objectivity and professional skepticism. Then independence in appearance. So prevents significant facts or circumstances that could lead a reasonable third party to conclude compromise in integrity, objectivity, or professional skepticism. So professional skepticism involves a questioning mind, alertness to conditions, suggesting possible misstatements due to error or fraud, and critical assessment of evidences. Now, compliance with fundamental principles individually and collectively reinforces the exercise of professional skepticism in an audit of financial statements as illustrated below. Now, professional skepticism involves a questioning mind, alertness to conditions, suggesting possible misstatements due to error or fraud, and critical assessment of evidences. Compliance with fundamental principles individually and collectively reinforces the exercise of professional skepticism in an audit of financial statements as illustrated below. Now, integrity. So, integrity, compliance action, and results. So, compliance action, being straightforward and honest when addressing client concerns. Being straightforward and honest when addressing client concerns. Pursuing inquiries and seeking additional evidence to address potential falsities in statements, and result demonstrate critical assessment of audit evidences contributing to the exercise of professional skepticism. Now, objectivity, compliance action, recognizing circumstances or relationships that may compromise professional judgment, considering the impact of such factors on judgment when evaluating the sufficiency and appropriateness of audit evidences, results behaving in a manner that supports the exercise of professional skepticism. No professional competence in due care. So compliance action, applying relevant knowledge to identify risk of material misstatements, designing and executing appropriate audit procedures, and critically assessing the sufficiency and appropriateness of audit evidences. Then results, behaving in a manner that contributes to the exercise of professional skepticism. Now, ethical conflict resolution. So, when resolving ethical conflicts, it is crucial to document the process and outcome, including relevant facts, outline the pertinent details, ethical issues, identify the ethical concerns at play. Then, fundamental principles specify the fundamental principles involved, procedures, document the established procedures followed, actions and outcomes, record the actions taken and their outcomes. Then, alternative courses, consider and document alternative courses of action with their consequences. Consultation sources, note internal and external sources consulted. Now, after evaluating these factors, a professional accountant must determine the appropriate course of action, weighing the consequences. If the conflict persists, consultation with others may be necessary, including legal advisors and or ACCA. Ensuring confidentiality is maintained. If the conflict remains unresolved, the accountant may consider withdrawing from the engagement or resigning from the firm or organization as a last resort. Now, independence standards. So independence requirement. Members offering assurance services must maintain independence from the assurance client. That is, they must be independent. They must be independent. It's not a choice. It's very, very required. Now, perceived. objectivity threats, perceived objectivity threats. So members not engaged in assurance services, members not engaged in assurance services may face perceived objectivity threats based on their work and client relationships. Okay, consideration is crucial for the influence of associations with other firms and partnerships. Example, ABC Audit, ABC Tax Services, ABC Valuation Services. Despite being distinct legal entities, their independence from each other may not be adequate. Right? Then fees. That is very, very important. Fees. So in general, while negotiating and receiving fees directly from an audit client is a common practice, it introduces self-interest threats and potential intimidation threats to independence. The extent of these threats influenced by various factors: fees level and resources. Are you dependent on that fees or not? For example, if your total revenue say 1 crore and you're drawing say 60 lakhs from one client only, then you're dependent on that client. So the fee amount considering the resources required affects the level of threats. If it is overcharged, then independence might be compromised. So it should be based on the resources that are required. Then dependency on service outcome. So the degree of dependency between the fee and the service outcome contributes to threats. Then firm's operating structure. So the firm's structure and compensation arrangements impacts threats to independence. Then client significance. The significance of the client to the firm, office or partner influences threats. Then client nature, whether the client is a public interest entity and its nature affects independence threats. Then involvement of those charged with governance. So the role of those charged with governance in appointing the auditor and agreeing on fees is a factor. Then quality management system. So the existence of a quality management system as per ISQM 1 chapter 5 may influence the evaluation of whether threats are at an acceptable level. Now, careful consideration of these factors is crucial to maintaining independence and ensuring the integrity of financial statements for the intended users. Now, level of audit fees. So, factors and safeguards for audit fee related threats. Factors in evaluating audit fee related threats. So, firm's commercial rationale. Evaluate the firm's commercial rationale behind the audit fee to understand potential self interest threats. Client induced pressure. So, assess whether the client is applying undue pressure to reduce the audit fee, which can lead to intimidation threats. Now, safeguards for audit fee related threats. Safeguards for audit fee related threats. So appoint an independent reviewer not involved in the audit. 2. Assess the reasonableness of the proposed fee considering the engagement's scope and complexity. Review the work performed, providing an additional layer of objectivity. Now, implementing these safeguards helps mitigate threats related to audit fees, reinforcing independence and the integrity of the audit process. Impact of other services. Can other services be provided by an auditor? Yes. So the sole exception to the prohibition lies in recognizing cost saving stemming from experience gained through service other than audit. This limited consideration allows for acknowledging the positive impact on cost while upholding the broader prohibition to maintain independence. Okay. Now, contingent fees. So sometimes you provide other services, you gain experience, and then you leverage it into your fees. Now, contingent fees. Is contingent fees allowed? Let's understand. What is contingent fees? Depending on the outcome of a particular event. Depending on the outcome of a particular event. That is contingent fees. Okay. So contingent fees refers to fees calculated on a predetermined basis related to the outcome of a transaction or the result of the services provided. These fees are contingent upon a specific event or outcome and are often tied to the success or performance of the services rendered. Contingent fees for NAS to audit clients are prohibited if the fee is material or expected to be material to the firm, or the outcome of the NAS and consequently the fee amount depends on a future or current judgment related to the audit of a material amount in the financial statements. Now, total fees, proportion of the fees for other services. So, factors for threat evaluation, ratio of other service fee to audit fee. So, if the ratio is equal or the ratio of other audit fee is more, then you are dependent on the client, then independence cannot be proved. So, assess the proportion of fees generated from other services related to the audit entity, audit fee, then duration of high ratio. So, consider the length of time during which a high ratio has existed, nature, scope, and purposes of other services. So, evaluate the nature, scope, and purposes of other services, including whether they are recurring services or whether legal or regulatory requirements mandate the services to be performed by the firm. Then safeguards, appropriate reviewer. So assign an independent reviewer not involved in the audit or other services to review relevant audit work. Then limiting other services to reduce the extent of other services provided to the audit client to mitigate the self-interest and intimidation threats. Now, total fees. So, fee dependency, all audit lines. Factors for threat evaluation. So, significance of audit overdue fees. significance of overdue fees. The importance of overdue fees to the firm is a relevant factor in evaluating self-interest threats. Duration of overdue fees. The length of time fees have been overdue influences the assessment of threats. Audit clients' payment ability and willingness. Evaluating the audit clients' ability and willingness to pay overdue fees is crucial in determining the level of self-interest threats. Then safeguards. Partial payment agreement. Obtain partial payment of overdue fees to address immediate financial concerns. Independent reviewer. Engage an unbiased reviewer not involved in the audit engagement to scrutinize the audit work. Now, please note, when a significant portion of fees remains unpaid for an extended period, the firm must assess whether the overdue fees might be deemed equivalent to a loan to the client. It is appropriate for the firm to be reappointed or continue the audit engagement. Addressing these considerations is essential for maintaining independence and the integrity in the audit process. Now, fee dependency and public interest entity. I think this should be the last topic that we should cover today. Otherwise, we won't be able to finish the next topic within the due time. So let's do this. Fee dependency on public interest entities. Okay, so what is the fee dependency criteria for public interest entity? So public interest entity pie, a pie falls within categories such as a publicly traded entity, an entity handling public deposits, an entity providing public insurance, or an entity specified by law, regulation, or professional standards to meet its stakeholder expectations. Then publicly traded entity, so a publicly traded entity issues transferable financial instruments traded on a publicly accessible market, including stock exchanges. Then listed entity and public interest entity pie revision. So the SBA revisions April 2022 broadened pie categories, introducing the term publicly traded entity to replace listed entity. Fee dependency threshold. So for 2 consecutive years, if fees from a pie client exceed 15% of the firm's total fees, the firm must consider a pre-issuance review. Let's understand this one. Okay. So now listed entities word is not used, publicly traded entity is used. Publicly traded entity could be without listing also, so that is why publicly traded entity is used. Now fee dependency threshold. So for 2 consecutive years, if fees from a pie client exceed 50% of the firm's total fees, that is fees total fees of the firm versus fees from pie client, if ratio is 15% or more, the firm must consider a pre-issuance review. That is, before issuing the report, they must get it reviewed before issuing the audit opinion on the second year's financial statements. That is, in the second year's financial statement cannot be issued. Second year's audit opinion cannot be issued before having a pre-issuance review. Then long-term dependency. So if this fee dependency persists for 5 consecutive years, the firm must cease to be the auditor after issuing the audit opinion for the fifth year. That is, if this ratio goes above 15% for consecutively 5 years, consecutively. Okay, if there's even a gap of 1 year, then it's not consecutive. A regulatory but they'll not have to resign, they'll not cease to exist as auditor if a regulatory body finds compelling reasons considering the public interest to continue. That is, a regulatory body finds that you should continue the audit, or a pre-issuance review is conducted before issuing the audit opinion for the sixth and subsequent years. A pre-issuance review is done, which will anyways be done, right? If after 2 consecutive year it needs to be done, then definitely after fifth year it will also continue. So these measures aim to address threats to independence arising from prolonged fee dependency on a specific pipeline, because if there's a prolonged fee dependency, then if later on if some fraud, some irregularity is identified, maybe you won't be willing to report it, or you might not feel like reporting it. Now fee dependency pie, or you might conclude that you should not report it. Now fee dependency not pie in case of non-pi. So when for each of the 5 consecutive years, fees from a non-pi client exceeds 30%, not 15, 30% for non-pi of the firm's total fees for 5 consecutive years. There's no rule of 2 consecutive years. The firm must assess whether the following action can reduce threats to an acceptable level. Firm must assess whether they should do it or not. Pre-issuance review. Before issuing the audit opinion for the fifth year, have a professional accountant external to the firm review the audit work for that year. Post-issuance review. After issuing the audit opinion for the fifth year and before the sixth year, have a professional accountant external to the firm or a professional body review the work of the fifth year, not sixth year, fifth year. So pre-issuance and post-issuance review. You have to evaluate what you need to do and you can do it. Is both required? No. Both are not required, only one. These measures aim to mitigate threats to independence arising from prolonged fee dependency on a specific non-pipeline. With this, we are closing today's session because we will not be able to complete the next pointer. In next lecture, when we will meet, we will start from heading 3.2. Thank you so much. And I really request that if you want to join from the ongoing sessions from the next week, please complete your recordings for the current sessions, because it is very very important. Okay, in case of audit, please do not take it lightly. Okay, you have to complete the lectures, you have to read the notes, you have to solve the questions, then only you will be in a league to pass the examinations. Okay, so it is not a study that you can do at the end, you have to follow it from starting. Okay, so thank you so much, see you all in the next class. Thank you.